Pitfalls and Risks. Introduction to the module. Short-term currency speculators have one massive advantage over long-term market participants. They can decide whether and when to enter and exit the forex market. International investors, tourists, and importers and exporters, for whom forex is a secondary consideration, must trade currencies when their primary goal dictates. Forex traders, in contrast, can stay out of the market until the best opportunities arise. Although they have this advantage, they still need to be aware of the pitfalls and risks if they want to be successful. This module will remind you of the dangers you must endeavor to avoid. Currency risk. It is often said that the forex market is a zero-sum game, a winner for every loser. But this is not strictly true because, for long-term players, the forex is just a stepping stone to somewhere else. Assume a UK investor sells cable to a speculator and buys US equities with the proceeds. The S&P 500 rallies 50% and British pounds or United States dollars climbs 10%. The speculator wins, but the investor's portfolio is also up 40% in local currency terms. Who loses? Long-term market participants are sensitive to the price and timing of their overall strategy, not just the forex part. For example, a firm or investor will not cancel an import contract or unwind an equity portfolio just to reverse a currency deal. These market participants are not short-term profit-oriented, or, in the case of central banks, not profit-oriented at all, and they have little choice in the timing of their transactions. In contrast, the ability to choose when to enter and exit a position is the speculator's edge. It is also the primary tool to limit the risks of forex trading. Volatility. Traders can choose not to enter a new position just ahead of major economic data releases, when market prices might be excessively volatile. Similarly, they can avoid the market altogether when they expect liquidity to be low, like between the US and Asian trading sessions, or on days when a major financial center has a public holiday. Trading at these times presents additional risks, because a lack of quotes might preclude transactions at the desired price, slippage. An exit strategy is of little comfort if it is impossible to execute. Poor strategy. Entering the market out of impatience or boredom also increases the risks. Each potential opportunity must respect the predetermined reward-risk ratio before it becomes a trade. It is better to stay out of the market than to enter a deal that would worsen your chance of long-term success. The market will present more opportunities tomorrow. The essential tool for limiting risk once one is engaged is the stop loss. You must decide on the stop loss level before opening a position and leave the order immediately. Never push a stop loss away, in other words, reset it to a level where you would incur more significant losses than initially planned. It can sometimes be tempting to give the position a little more breathing space. But this sentiment is a product of our loss aversion, not a careful re-evaluation of the strategy. Forex addiction. The forex markets are fast-moving, high-stakes arenas where the win-loss ratio of even the best traders is probably no better than 50-50. The comparison to gambling is easy to make. Yet, successful forex trading is not exciting. It is a plan for making profits over the long term. It involves waiting patiently for exploitable opportunities to present themselves, then waiting some more until either objectives or stop losses are reached. Successful forex trading is supposed to be boring. The market does not know whether or not you are watching it. So, staying glued to the screen to watch the evolution of the latest position in real time brings no advantage. If you feel you must check prices regularly, or you have extended your trading day into other time zones, you should consider reviewing your strategy. The risk management rules exist to make your trading career sustainable and to give your trading strategy every chance to succeed. If you attempted to abandon these rules by taking larger position sizes, increasing the leverage, or modifying the reward-risk ratio, you should stop trading altogether. Broker or credit risk. All cash forex transactions, even retail trades, ultimately end up with banks and brokers in the interbank market. The bankruptcy of one of those institutions would present a risk for the assets of the forex trader and considerable disruption in the market. To benefit from deposit guarantee schemes, you should choose a bank that is regulated by local financial authorities, or use the services of a currency trading provider who partners with a regulated bank. One of the main advantages of trading currency futures on an exchange is that all counterparties must post collateral for their trades in the form of a margin. The margin, held on a segregated account, is sufficient to cover any eventual losses. This arrangement means all other counterparties are protected, even if the exchange itself were to fail. Online trading risk. Online trading, although convenient and low cost, also brings with it the risk that the service goes down. To reduce this risk, you must have redundant communication systems in place. For instance, if the PC or cable connection fails, it must be possible to trade from an alternative device using a mobile network, or to call the service provider on a fixed line. Test these redundant systems regularly. Interest rate or rollover risk. If you do not close all cash positions by the end of the day, you will be exposed to rollover risk. This risk arises because the spot delivery date changes. For example, if you go short United States dollars or Japanese yen today and rebuy tomorrow, the delivery date of the second transaction will be 1 day later than the first, more if the new spot date is on the other side of a weekend or public holiday. To match the two, you must roll over the delivery of the first transaction into the new spot date with a forward deal. Typically, the service provider will do this for you. In practice, this means borrowing the dollars and lending yen over that period. If the interest rate for dollars is higher than that for yen, you will pay for this operation. The inverse would be the case for long United States dollars or Japanese yen positions. You must be aware of any rollover costs or earnings if you plan multi-day positions and build these into your reward risk calculation. Country or political risk. The actions of the governments and central banks that issue a currency are the principal country or political risk. Direct intervention in the forex market is rare in the 6 most frequently traded currencies, but it is a standard policy tool of monetary authorities. Less likely are exchange controls to limit currency trading, or capital controls to restrict assets leaving a country. As the risk of any of these eventualities mounts, the shrinking liquidity should serve as a warning to retail traders. Summary. The ability to choose whether to be in the market or not is the most potent risk mitigation tool at your disposal. You must not let poor strategy, loss aversion, excitement seeking or addiction prevent you from using it. Avoid markets where low liquidity is expected. Consider rollover costs and the possibility of slippage when determining reward-risk ratios. Put in place redundant systems and test them regularly. Trade currencies of countries that have low political risk and diligent regulators.